I stopped trying to pick winning stocks. Now I just get paid to wait for them. In the past 2 years, I made over $45,000 in premium from doing this. Not from stocks going up, but getting paid to wait for them. My name's Marcus, and I've been in the market about 10 years. But in the last 2 years, I've run almost nothing except one strategy. It's called the wheel strategy. And here's why it works. I get paid every single week, whether the stock moves up, down, or sideways. Time works for me, not against me. If you're starting with around $50,000, that comes out to around $1,000 a month, or roughly 25% a year. Today, I'll show you the exact setup live on real platforms, and then I'll walk you through a live trade example. Let's get into it. Real quick, who this is actually for. If you have 5 figures just sitting idle, packed in stocks, or just sitting in cash in general, and want to make weekly income, this is for you. Here's why I run this over everything else I've tried. Most traders try to predict the market. Right stock, right timing, right direction, but they end up bleeding out every time. With the wheel strategy, you're not betting on the stock taking off. You're getting paid whether the stock goes up, down, or sideways. Time stops working against you and starts working for you. Every day that passes by, you're collecting. I've made about $45,000 in premium over the last 3 years, mainly trading Tesla, Palantir, Nvidia, and Robinhood. The first step with the wheel strategy is to find the most ideal stock to run this strategy with. I like to use a screener to filter for stocks that work very, very well for this strategy. The first thing that I like to take a look at is the market cap of the stock itself. This is the size of the company, the number of outstanding shares times the current share price. I like to set this custom range to at least $1 billion or higher in market cap. We'll save that. We'll give this a name, wheel, save that. We'll go back. I like to take a look at the actual options trading volume as well. This is very important for liquidity and being able to get in and out of your trades easily. So we're going to go to options average trading volume. We're going to choose over 5,000 contracts traded on a monthly basis. We'll save that. Next, the last thing that I do like to change is the implied volatility. And this will vary based on your risk tolerance. So implied volatility is just a measure of how much the stock is projected to move in the next 12 months. I like to change this between 40% on the low end and 80% on the high end. I don't like to go above 80% because the stocks get too volatile and they can move too quickly. I don't like to go below 40% because the premiums I'm collecting aren't going to be high enough. So I'll save that 40% to 80% implied volatility. And lastly, this one can be based on your portfolio value, but share price is very important for this type of strategy because each contract needs 100 shares worth of capital in order to enter it. For example, if I choose under $50, these are positions under a $5,000 total amount needed for the cash secured put, which is the first part of the wheel strategy. So here, this filters out stocks for lower price portfolios, anything under $5,000 per contract. Save that. And that is pretty much the last thing that we'll take a look at for the screener. Now let's move on to selecting the cash secured put strike price together. So I'm on the 6-month time frame and I use 2 main indicators to choose the strike price of my cash secured put. I have the Bollinger Band pulled up here. You can quickly take a look at the settings if you need them here. 20-day simple moving average, 2 standard deviations of data for the Bollinger Band, which is the blue ring around the price movement here, which is the black line. Next, I like to use the 30-day moving average just to see where it's trading in relation to that as well. So if we zoom in here just a little bit on the price of Nvidia at the moment, it looks like it's just below the bottom of the Bollinger Band. You can see it's just below this 200 value at 202. So that is exactly where we want to agree to buy the shares at and agree to sell a cash secured put there in order to get paid that premium upfront for agreeing to do that. This looks like one of the better setups that I've seen this week, especially with Nvidia trading so low at the moment. Let's take a look at some premiums we can take a look at in Robinhood right now. So now we're in Robinhood in the options chain itself. I'm going to choose sell put at the top to agree to buy 100 shares of the stock at the strike price we choose. I'm going to choose about a week till expiration. In this case, it's going to be July 1st, which is about 8 days away. I like to stick to shorter term expiration dates, mainly for 2 reasons. The first one is because I can reinvest my profit at a quicker rate. I realize that premium after a week, I can reinvest right away. And second is because I'm only in the trade for a couple days. This doesn't give much time for the stock to move in this 7 to 8 day period. So I'm going to choose the July 1st expiration date. I'm going to scroll down through the options chain, and we're going to actually choose the $195 strike price here. We collect $156 for agreeing to buy 100 shares of NVIDIA if it reaches $195 or lower on our expiration date, which is currently set to July 1st. So that's realistically the two things that can happen. First thing is the price of NVIDIA can be above $195 on July 1st. In this case, we would not be forced to buy those 100 shares of the stock. We'd keep our $160 of premium for ourselves, and we'd basically be able to repeat this the following week. That is ideal. That is the goal with this strategy in general. Worst case scenario is the stock does drop below $195 on the expiration date of July 1st, and we're forced to buy those 100 shares. We still keep the premium of $160, but now we are forced to buy the shares at $195 no matter how low below $195 the stock may go. Here's an example of where I got assigned on HIMS and was forced to buy 100 shares of the stock at $37 a share. You can see my entry costs here. I do own 200 shares at the moment. It makes up about 11% of my total portfolio value. I am slightly down and have an unrealized loss in the shares of about 8% at the moment. So what I've done here is I've sold two different covered call options. One at the $37 strike price, which is my entry cost, for expiration this week, which is the 26th of June. Additionally, I have sold a cover call at the $37 strike price for July 10th to offset my entry costs and my expiration dates in general. You can see with this $37 cover call option that expires this week, I collected $122 upfront for agreeing to sell my shares basically at the price I bought it at. Just to do some quick math on the sort of return that I'm getting with this specific cover call option, I collected $122 of premium. If we divide that value by $3,700, the amount of cash that is actually in HIM stock at the moment, that's about a 3.3% return. You can see I entered this position on the 18th of June, and it does expire about a week later on the 26th. So that's about a 3% return in just 1 week. That's well over 100% a year if you're able to do this every single week of the year. So realistically, the premium I'm targeting every single week is about 0.5% to 1% return on my capital on a weekly basis. That does equate to around a 25 to 50% return per year. If we go back to that HIMS example, I entered about $3,700 worth of cash into that stock. 0.5% of $3,700 is about $18 a week. Doesn't seem like a lot. It does equate to about 25% a year if you're able to get that return every single week. Yes, there are risks with this strategy. If you put $50,000 into the strategy itself and the stock, for example, falls down in value, like this HIMS example, where I am down about 8% on the shares themselves, you can continue to sell covered calls against your stock position to collect premium to offset your entry costs. Although you do have an unrealized loss, it's not the end of the world if you're willing to own the shares for long term while the stock recovers. Everything I just showed you is the strategy, nothing held back. But here's what I can't do in a YouTube video. I can't tell you which puts to sell this week or what puts you're going to sell this week depending on your account size, or if you're having trouble deciding what to do with a position, whether to roll it, whether to take assignment, or whether to just wait it out in general. That's what I do one-on-one. If you're serious and you've got at least $30,000 to put to work, you can book a free call with me. The link's right below this video. We'll look at your account, your goals, and figure out if this is the right fit. No pressure at all. and I'll put my money where my mouth is. If you start with at least $30,000 and don't make $2,000 in premium within the first 90 days, I will personally compensate you the difference of what you don't make. For example, if you make $1,500 in 90 days, I'll personally compensate you that last $500 to make up the difference. That's how confident I am in this. So stop letting your cash just sit idle doing absolutely nothing. The link's in the description below. Let's get you collecting.